Welcome to the second chapter of this masterclass on integrating risk and finance in association with SAP. My name is Brian Caplen, editor of The Banker, and to discuss this topic, I'm joined by Mike Russo, who is SAP's Senior Financial Services Solution Principal, and Falk Rieker, who is Global Head of Banking. And in this chapter, we're going to discuss liquidity risk and how to strike a balance between regulatory compliance and business value. So welcome, gentlemen. Mike, if I can start with you. I mean, the regulators are saying that they want the banks to hold much more liquidity. What sort of challenges does that throw up for the banks?
Well, I think, we sort of can harken back to the whole data topic again, So one of the big challenges for banks is, how do they integrate or harmonize, let's say, cash flow data from across the enterprise? Many of the source systems that they're using aren't able to provide cash flows. So I think the immediate challenge is, how do I bring together and integrate data at a very, very granular level in order to be able to aggregate it and support some of the regulatory ratios.
Okay, and the thing is, liquidity has a bit of a cost, doesn't it? So, there's a real kind of upside in the banks getting this right and doing it in the most efficient way.
Yeah, absolutely. If you think from the regulatory perspective, right? Regulators would love you to have a completely liquid balance sheet, right? But we all know that liquidity comes with a cost, and therefore, I think part of the challenge banks need to address is, fulfilling the requirements of regulators, but at the same time, fulfilling the expectations of the shareholders who would like them to be able to make an adequate return on the capital that's invested. So that's the challenge. Like I said, it's pretty easy to have a totally liquid bank. The challenge is really to determine what's the appropriate level of capital such that regulators are satisfied, with respect to the safety and soundness of the particular institution. But beyond that, what's the appropriate level so that shareholders can gain an adequate return on their invested capital.
Okay, so where do you think we're going with all this liquidity stuff? Are regulators just going to keep asking banks to have more and more liquidity? Where is it going to stop?
No, I think it's about optimizing liquidity here. And when you look at the past, managing liquidity was a highly manual process in banks, and a lot of guesstimates were done. So I think technology enables banks today and brings them in a position that they can manage liquidity much more intelligent, meaning optimizing where they hold the liquidity for what purposes, and then also look at it not only on a day-end basis, but potentially during the day, intraday as well, and do certain simulations.
So in a way, what you're saying is in the past, banks would have had a lot of liquidity which they wouldn't really have been either aware of or they wouldn't have been using it effectively.
Exactly. So the transparency on the underlying cash flows, transparency what the inherent risk going along with the liquidity positions they have, I think was not managed as efficiently as it could be, and that's where technology kicks in.
Okay. Now the other thing, Mike, is the regulators both in the US and in Europe, they're pushing stress testing on the banks and scenario planning. What are the impacts of those on a bank's liquidity risk management?
Yeah, so I think if you ever want to get to optimization, right? The way you get there is to have dynamic scenario analysis and stress testing, right? You need to try out a lot of different scenarios in order to determine what's the appropriate level of liquidity. So
and see how liquidity would behave under certain situations.
Exactly, and part of the challenge again harkens back to technology, because in order to run these simulations, it was very time consuming. In certain cases, you would build a scenario, it would take a day or more for the scenario to run. So some of the new technologies, essentially enabling banks to run these scenarios very dynamically and to be very proactive, in their scenario analysis. So I think, when you talk about liquidity risk management, the heart and soul of that is scenario analysis. Again, we've got regulatory issues we need to deal with, and they're prescribed. But scenario analysis and stress testing are really the keys, for a bank, to be able to optimize their liquidity positions.
So I remember hearing about one bank that was doing something like 30 scenarios a day. Do you think that's the right amount, or is that too ambitious?
Yeah, I think it's not necessarily the amount of different scenarios you're going through. But getting back to the term liquidity optimization, it's that possibility to run the scenarios intraday, especially when you face volatile markets. You need to react very quickly with your liquidity positions to these market reactions. And I think this is where real-time technology and other beneficial technology pieces can benefit and help to contribute to optimize the liquidity.